As in traditional financial intermediation, the financial inclusion sector functions as a value chain. FSPs collect funding from depositors, investors, and donors, and lend these funds to individuals and businesses as part of their financial intermediation role. Regulators and supervisors provide the rules of the game and check that the rules are met by financial institutions in order to maintain stability and fair competition in the financial system. Since the Covid-19 pandemic began, many countries have implemented lockdown policies and business restrictions. The interruption of business activity, confinement and mobility restrictions, and the increasing infection and mortality rates have meant that the financial inclusion sector has faced a number of challenges and risks. If we look at risks, low-income clients were the most affected, impacting mostly on small retail businesses as well as smallholder farmers in commodity value chains. For example, in Uganda, lockdown restrictions prevented small retail businesses from selling, hindering their capacity to repay their loans. Moreover, business supplies coming from abroad did not arrive to their destination, leaving many small businesses without anything to sell, and sometimes with liquidity problems since they had already paid for the supplies. In other cases, the pandemic interrupted the food value chain, causing food shortages. Nevertheless, in some cases, the agri-sector was one of the most resilient sectors during the pandemic. In Tajikistan, for example, during May, June and July, the agri-loans portfolio performed better than the consumer and business loans. Also, the flows of national and international remittances were affected. However, in some cases like Mexico, international remittances from the USA to Mexico increased during the pandemic by 10%. Another risk associated with lockdown restrictions is the fact that non-paid work and household violence have increased for women, limiting their ability to undertake their productive activities. This is an important issue since the vast majority of MFI's clients are women. For financial institutions, the liquidity risk is probably the most important concern due to increasing deposit withdrawals, inability to collect loan payments, reduced capacity of borrowers, and funds from investors not being renewed. Credit risk is the second most important concern, again mainly due to the lower ability of clients to repay and movement restrictions. In other cases, the client chooses not to repay, leading to moral hazard problems. For this reason, face-to-face relationships and stronger ties with credit officers can favour traditional FSPs over digital FSPs. Operational risks due to losing staff or sick employees was expected during the pandemic. However, many microfinance institutions have implemented several measures in their branch offices and with their employees to reduce the chances of fraud and procedural errors. In other cases, microfinance institutions have introduced the use of digital platforms in order for their loan officers to interact with their group meetings. Risk leads to challenges for SFPs. Liquidity problems push FSPs to look for additional funding with national and international investors. Movement restrictions have meant for some FPs to maintain continuous communication between credit managers and clients through WhatsApp, Viber, Skype calls and Zoom webinars, but also by implementing new services and products through digitalization. For others, they have had to acquire new clients from more stable sectors such as the agri-sector and by implementing digital channels and new products. Nonetheless, a bigger issue emerges from poor connection and its cost. Digitalization seems to be a solution to some challenges, but it is expensive and can't fully reach the most remote clients, particularly those in poverty who don't have internet access. Mixed models are being used to bring offline communities into a digital platform by using a network of agents who are present in villages. Investors also face risks and challenges. For example, some debt-based investors don't receive repayments, so they can't provide new funding. Sometimes they are only able to provide committed disbursements for existing contracts already signed. Lenders rescheduled many loans as a result of moratoriums at the level of MFIs, so they receive less repayments, resulting in less funding for new investments. These are some of the findings from the Research Digest that the Action Group From Research to Practice is undertaking with key actors of the financial inclusion value chain.